Okay, guys, I think somehow it's working now because I see people joining and also the participant getting the chance to speak. So I just kind of asked to both Sector and Ipor if you can confirm all your guys are set as speaker or if we have to wait for others.
Yeah, I think we're good. Dimi, you want to join?
We should all be set on the sector side.
Perfect, amazing. So I mean, we can kind of start now. As you know, today is more like a chat about volatility. Also, I think it's a great day to do that since we've been seeing Arbitrum having fun on the roller coaster with Arbitrum and the gas issue and everything related to that. So it's not like we will follow a very like strict agenda. It'll be more like let's chat about these topics and let's see if we have some good ideas to and good concept to share with the listener, to people that may listen to the space later on today. So just to start, maybe if you want to kind of quickly introduce what you're building and how it kind of relates to volatility, risk, and all those kind of things, and then we can kind of chat about what's happening today. So I don't know if you Sector maybe you want to start, then Ipor, and then Tempesto, our penguin traders, finishes with Smilee.
Yeah, sounds good. This is Peter Bed over at Sector Finance. We're a structured products protocol, and we're focused on providing comprehensive risk analysis and developing delta neutral and market making strategies. We went live a few weeks ago. We have about 2.5 million in TVL, so response has been good. And the big news for us is that we are launching via Camelot Dex next Wednesday. So yeah, this is Peter Bed. I lead the everything non-technical on the side of sector. With us is also Saga, who yeah is one of the technical co-founders.
Amazing, great to hear. So I don't know if you, Darren or Dimitar, want to add something on Ipor.
Yeah, sure. So Ipor is two things. It's interest rate benchmark, and it's also an interest rate derivative. So if you think, the benchmark tracks the volatility in the interest rates, and the derivative helps you hedge against this volatility, and it may be extremely pertinent given the macro situation. So if you think of the Ipor index and what will be coming will be the forward rates as a vital part of term structure in DeFi. The really banking risk that happened recently can be boiled down to two things. One is duration risk, and the other is interest rate risk. So that's really a very good topic in the macro.
Amazing. Tempesto, now it's your turn.
Yeah, absolutely. So I'm Tempesto, the penguin trader from Smilee. So I'll briefly introduce Smilee. Smilee is a platform to basically create and trade derivatives on chain. And the concept here is that we start from liquidity providers because liquidity providers, like people providing liquidity to DEXs, are actually selling options, even if they don't realize. Because they're exposed to impermanent loss. So when there is more volatility, they lose money. So basically what Smilee does is to convert these positions from liquidity providers into options and sell those options. So with Smilee, liquidity providers can provide liquidity, and that liquidity is used to mint options that people can buy, and the premium paid by these people goes back to the liquidity providers.
Amazing. I love all these free products, obviously. I love also the Smilee one as well, as you may imagine. So let's move to talking about risk and volatility trading. So you all guys are super expert of this. It's an advanced topic. Super. The more you dig into that, the more it gets interesting. So I say, I mean, today is an interesting day to have this thing. Maybe people are actually experiencing the complex of volatility trading or somehow things related to volatility are present quite a lot. And so maybe later today they'll see there was a panel on something similar. So I leave it to you to start saying something about how what are you seeing today in the market? What do you think? And anything related to volatility from that point on. You choose who wants to start. I mean, it's the same. Otherwise, Tempesto, since we are hosting this Twitter space, in case you have to start.
Yeah, okay, cool. Yeah, so what we're seeing at the moment, I think is very interesting because we've got this new narrative that crypto, and in particular Bitcoin, may be seen as a risk-off asset, something that goes bid, that grows in value when the banking system has some troubles. So, of course, what the Fed said yesterday is very interesting. They raised rates 25 bips. They're also saying they're not going to cover all the deposits by people. And I mean, Bitcoin over the last couple of weeks actually basically rose in value the worse it got for the financial system. And some people, as you might know, for example, Balaji is betting on Bitcoin going to 1 million. Of course, that's really not the it's a very out of consensus bet on the financial system collapsing, and it's probably very unlikely that this is going to happen, but it still made a lot of attention on it. So I mean, there is definitely a lot of volatility in the market. Crypto moved from being a full risk on asset, now it's perceived more to be a risk off asset. So also trading volatility on crypto is getting more and more interesting. And we've seen, for example, after the Fed meeting yesterday, Bitcoin volatility, but also ETH volatility dropped quite a lot, especially on the front expiries. And this is, of course, something that happens pretty much every time there is a big event. So maybe what do you guys think about this situation? Is crypto a little bit more of a risk on asset or a risk off asset in this scenario? And what are the right ways to trade this current economic scenario using volatility?
Bitcoin is beautiful because we always rephrase it to whatever narrative fits the current. So let's call it a risk off for now.
Yeah, happy with the narrative of Bitcoin going risk off. We'll second that.
And if it's risk on, then let's call it risk on, because then it will also be beneficial. So those are my two bets.
So long Bitcoin?
Yeah, I mean,
Yes,
that's what you guys said is very true. I mean, Bitcoin changes narrative every now and then. There is always a new narrative, and this time it's very much the risk-off narrative. But it may be different tomorrow. Yes. So I'm curious to hear about your experience with trading volatility. I mean, were you guys volatility traders, or you had some experience there before actually going and build products about volatility or risk? So yeah.
I can kick it off. Actually, Flash Loner from our team just joined. I think
Yeah, I'm trying to connect in him. Let's see
Okay.
if it works. Sometimes with Android, we realize it doesn't go through. So in case Flash Loans, if you hear us and you're from an Android, try to find an iPhone. No, okay, fine, it's working.
Okay, yeah, I think he's good.
That was
yeah, Flash,
easier than.
I don't know if you heard the question, but it was around our experience with volatility, trading it, and just a quick intro for Flash. He's just one of the other technical co-founders.
Hey everyone, sorry I'm a little late. But yeah, we haven't been doing outright volatility trading, or at least I haven't been, but we've been looking at, I mean, we deal with the same kind of questions with in designing our market neutral strategies, because the strategies that we build is for basically market making DEX pairs, right, like on Uniswap, but doing it not in kind of this traditional LP way, but instead doing only, you know, hedging one of the assets, so you're only exposed to one underlying asset. So if it's like an ETH USDC pair, we have a strategy where you can just deposit USDC and it borrows the ETH portion. So you're hedged, and then as prices moved, it actually rebalances. It'll rebalance the position. So you're kind of rebalancing away the impermanent loss. So basically, it's a right. It's like you are trading volatility. It's sort of similar to selling a straddle, where you know, if volatility is too high and you're kind of getting bounced around a lot, you're going to lose some money on each rebalance. But if it's, you know, if it's if it's fairly low, price is not moving too much, or it's moving slowly in one direction, then you can earn yield on, you know, on the trading fees, if there's extra rewards. So it is. So we are kind of, when building these strategies, we are looking, you know, back testing different kind of historical data, back testing periods of volatility, and definitely looking at volatility to kind of fine tune the parameters and stuff like
Okay,
that.
so let me get this straight. So basically, when you provide liquidity into sector, you get, I mean, you choose a pair, for example, ETH USDC, you can just provide USDC, you borrow the ETH part, and then you provide liquidity in ETH USDC, and this goes to, I don't know, UniV3. What kind of DEX do you use behind to provide liquidity?
So we focus on UniV2. UniV3 is
Okay.
actually, we found, just looking at it, it's a little bit too optimized, right? I feel like it's actually, most of the time, it's actually not profitable to provide liquidity on UniV3. Whereas UniV, and I think it's just, right, my theory is that it's just the UX of, you know, seeing this like 100% APR, but you're not realizing that you're, right, like users are not realizing that your impermanent loss in that case is, you know, could be like 10x or up to 20x depending on your
Yeah.
range, right? It's just
Yeah,
it's
it's just
basically
not a
leveraged
product for retail.
Yeah, it's like it's like
It's
leveraged UniV2. So UniV2, I think, is tends to be more, the risk pricing there and volatility pricing tends to be a little bit more in favor of providing liquidity and market making.
Yeah, absolutely. I mean, definitely the V3 is more for professional investors, that they want to provide liquidity that is very concentrated in a very capital efficient way, and maybe they like moving around their liquidity and so on. But of course, yes, the impermanent loss is also a lot bigger if you provide concentrated liquidity. So yeah, I completely get what you're saying. So basically, from what you said, the strategy is delta neutral because you're only providing USDC and you are basically borrowing ETH on the other side. And then how do you rebalance this? How do you keep ensuring that the position stays delta neutral when the market moves? Because yeah, I mean, when you are providing liquidity, you are short volatility. It's like selling a straddle, as you
Yeah.
said. But this basically means that if the market goes up, if ETH goes up, you are actually short ETH. So you need to buy a little bit of the ETH back. So how do you actually do this in practice?
Yeah, and that's what we do. So we specify a range. Right now, it's fairly simple. It's just like a fixed range that we can set in the smart contract, and we have keeper bots that basically monitor the position constantly, and once it hits a certain threshold, it will do exactly that. It'll either buy a little bit of ETH or sell a little bit of ETH, and get the position back into delta neutral state.
Okay, interesting. Cool. And the vaults have an expiry, or are like vaults that just keep going and this bot keep doing the delta hedging and you can get in, get out when you want?
Yeah, you
How
can
does
get
it
in
work?
and get out. Yep. Yeah. So that's the main strategy. Kind of we've been running this strategy for a while now on Moon River. So we're in the process of kind of like our next iteration is going to be just expand that offering onto more chains and do more pairs and so on.
Okay, cool. So maybe Darren, if you want to describe a little bit how Ipor works a little bit more in detail, and basically, give like detail of how people can interact with it, what people can do, and so on.
Yeah, sure. So basically, Ipor is, the interest rate derivative side is you're going to trade the volatility, and then the Ipor rate is sourced directly from the market. So it's a composite rate between Aave and compound, for example. And if you think of interest rate risk, you're really trading, I guess, longer terms of volatility. And it's very not a degen instrument. So for example, on the current app, there's potential leverage up to 1,000x, which in terms of interest rate risk, you're just talking about capital efficiency, right? So you're trading on the interest rate swap, a payoff over time. So if we look at the bank blowups, they're hedging, long duration interest rate risk, but in DeFi we don't have any term structure yet. So essentially, hedging rate risk is always a cost, right? So if you're trading interest rates, you can think of it more as an insurance product, right? It's a cost until it's profitable, until you really need it. So for example, we had some interesting interest rate behavior in DeFi over the Silicon Valley Bank collapse. And why? Because a lot of people were trying to offload their risk in USDC. So what we saw is actually the utilization rate on both Aave and Compound for USDT went to 100%, which means that that the borrowers were paying, I think, around 120% on their borrows, right? And so this is crazy interest rate risk, and unfortunately, you can't model for this on the AMM. So, for example, the AMM on Ipor, where you're trading risk, it essentially cuts, a spread above or below the Ipor, depending on which side you're going, either long or short, pay fixed or receive fixed. And then the pool is underwriting both long and short positions, right? So there's no model that can really account for, let's say, a steady state interest rate that's at at about 3%, and then for a number of days it spikes up to a sustained level of 60%. But the AMM is essentially tuned for volatility. It's using a couple of different quant models, like whole white, and a specific quant model called jump diffusion, which is specifically to model this interest rate behavior that we see in DeFi, which is these crazy rate spikes or rate jumps, and then this kind of reversion to the mean. So, the AMM is essentially a volatility to an instrument.
Okay, so that's pretty cool. I've been trading volatility for a long time, but actually I am more on I've been trading more the equity side. So I'm actually not an expert of interest rate, but you told us a lot of interesting stuff here. So first of all, actually, I wanted to understand a little bit better, why did these utilization rates go to 100% for USDT during this, following the Silicon Valley Bank collapse and the USDC, the peg? So was it just basically people borrowing USDT to sell it because it was the pegging on the upside? or was it something else? What is your interpretation of what happened there?
Yes, I think first of all, it was a flight to perceived safety, right? So this is the question. Is USDT safer than USDC? It always depends on your perception of counterparty risk, right? But in this case, when people were at the start of a panic, you have the least information, and you have the most disjointed markets. And then, for example, in the case where you shut off deposit or withdrawal functions at different exchanges, then you get this. You get this dislocation, in the different markets. So it's impossible to arbitrage. So what happened was we saw the depletion of on-chain liquidity for USDT. So USDT was trading at a premium, USDC at a discount. So that's first, is the flight to safety in the stables. And it's not necessarily, that's not credit market related at all. But then the very interesting kind of big-brained move that turned out to be very good and very profitable, and actually some of the largest whales in the Ipor pools were playing this, was this. So, Ipor, like every other DeFi protocol, saw, a pretty decent drawdown in TVL during this time. We're back, I think, 15% up from the, from the low. But it was hold USDT, borrow against your stables, sell USDT at a premium, buy USDC at a discount. And there was this pretty neat, it's 12 to 14% arbitrage opportunity where you're okay with, an annualized 120% borrowing cost because you're playing, a 14% premium, premium discount on the repeg
Yeah, you
event.
just hope it's gonna revert within a month or something like that.
Or no.
Otherwise...
It's a Monday. It's a Friday to Monday play. It's over the weekend. It's either Sunday or Monday. There's going to be an announcement, and you're going to have a repeg of the USDC. So it was more of like a 2-day play.
Yeah, no, absolutely. What I was saying is that even if you were to keep your position open for 1 month, then you would basically break even. So you are hoping that, ideally it's going to close in a couple of days, but yeah, you can hold your position for a while, even if you pay 100% interest rate on your borrow. Yeah, no, it does make sense. So thank you. Interesting perspective. Yeah, it's also, you mentioned there is really no term structure in DeFi at the moment, and that's very true. I mean, you can borrow spots, but you can't really lock your interest rate when you do so. So you just pay a variable interest rate all the time. So how is basically Ipor? How does Ipor fit into this? Does Ipor actually enable, for example, a term structure in DeFi or not?
Ipor is building, kind of the base instruments to enable the term structure in DeFi. So that's the most important thing. There, one moment. Okay, so Ipor is enabling this. So effectively what we're doing right now is there's an Ipor spot rate. There's a spot rate for USDC, USDT, and DAI, right? So that's what's the cost of borrowing now, block over block over block. So this is coming from the money markets, coming from Aave and Compound. What we need to do is get to, what's the rate of borrowing in 1 month, in 3 months, in 6 months, right? And we really took this approach as 1 month at a time because we are just kind of sticking our finger in the air. And actually the instrument that we have now, it's not technically an interest rate swap. It's more of a 4-week forward masquerading as an interest rate swap. And why did we do that? Because there is no way to get a 1 month rate except for creating the 1 month rate. So we took a kind of, a couple of different exercises, and we're trying to guess through a modeling exercise, what's the fair value of this interest rate swap 4 weeks from now? And that's how we created the first instrument. But from there, that will be interesting rate data to kind of set this 1 month instrument. Also, we hope that that will actually lead to more liquidity on these kind of fixed income instruments, the yield stripping instruments, different bond markets that are coming up. And so we can start extending, this kind of rate structure. So Ipor will be hopefully instrumental in one, extending the term structure of DeFi, two, being able to bootstrap a yield curve off of these different rates. So you can play different strategies, and this is another possibility for, if you're talking about volatility. Our head of institutional BD, Konstantinos, he wrote what was supposed to be a thesis. It's more like a treatise on relative value trading of rates. What's their application in TradFi, and then how this might play out in DeFi. So it's a 3-part series, so if you want to sit down for, maybe at least an hour, it's definitely worth a read. And then we'll use that kind of as, again, a treatise or a thesis, always going back to there, and seeing how this term structure develops in DeFi, and what are different strategies, not only hedging, but arbitraging, in what happened in the USDT, analysis. Actually, the USDT, rates shot through the roof, and the USDT decoupled, and I think it dropped. I can't remember how many basis points, but you can play the divergence on that. You essentially long USDT rates and short USDC, and that's a viable strategy depending on certain triggers. So these are other ways that you can play volatility using the interest rate swaps.
Really cool. So yeah, so I will get back later to actually maybe asking you how basically you can, like, what kind of users can benefit from this, from actually trading these forward rates with Ipor. But first, let me get back to Sector. So from what I understand, on Sector, I can just select a vault, deposit some money, and I can choose the risk that I want to take, basically. So there are some vaults that are more risky, some other vaults that are actually safer. So how do you calculate the risks of different vaults, and how do you manage those risks?
Yeah, so our aggregator vaults weigh their deposits by using our risk engine, our Galileo risk engine. And we approach measuring risk similar to sort of how insurance companies assess premiums. So we source all of the possible risk events associated with each strategy contract, asset and protocol dependency, etc., and find the value at risk and likelihood of each of these sort of risk associated events occurring in the span of 1 year. And then we sum those together, and you can use that to get like a value adjusted or a risk adjusted return. And then we convert those into like a 1 to 10 scale. And that's the engine, or sort of the technique that powers how our aggregator vaults are able to weigh deposits into underlying strategies while maintaining like a consistent risk score for users. So yeah, users can come to the site and choose basically like high or low risk from a scale of 1 to 10, deposit into one of the aggregator vaults, and be confident that their deposits will maintain like a relatively consistent risk score.
I have a question about that, actually, for the risk scoring, right? Are you depositing them into like different vaults, or do you have kind of this, I guess, virtual risk score across the entire protocol? Sorry, not across the entire protocol, across that particular vault, just from the engineering side.
Yeah, so we develop the individual strategies on our own, and then the aggregator vaults aggregate those. So the less risky aggregator vaults will likely be aggregating the more simpler strategies, like the lending strategies, and maybe some of the lowest risk, more complex strategy, like the hedged LP strategies. And then the higher risk, more degen aggregators will aggregate together the more complex individual strategies that we have.
Okay, so you have these lending strategies, you have LP like strategies where these are hedged, and then you have more complex. So in the more complex strategies, what kind of strategies are they? Like, where is money employed? What are the risks?
I mean, again, so that's so I would say that the hedged LP, these market making strategies are kind of in the more complex category, a little bit more risky. And then we also have leveraged versions of those strategies. So we use some protocols where you can actually borrow against the LP position itself. Right, so then you can get up to like 5x leverage or so. So then,
and this also means you have a liquidation, though, right?
yeah. So well, even the non-leveraged ones have liquidation because we're borrowing, right? In the USDC ETH example, we're borrowing the ETH from Compound or Aave. So there's a liquidation, right? Again, and it's a trade-off between how capital efficient you want to get. And how much liquidation risk you take on. In
So
some
here the
ways,
problem is if ETH goes up, right? Because like if ETH goes down, you don't have any issue. I mean, you're still probably losing from impermanent loss because you are providing liquidity in ETH USDC. But I guess the big impermanent loss happens on the upside. So let's say ETH goes up 2x really quickly, and sure, there is going to be your bot buying ETH all the way up and kind of trying to offset the amount of money you lose from gamma. But of course, it's going to be an issue here, especially if you're leveraged on this position. So the way you manage this is that you basically you set parameters and leverage at a level that you're comfortable with, using some assumptions on the volatility of the underlying assets, right? So are you looking at realized volatility? Are you looking at implied volatility? What is your risk measure here?
Yeah, we're looking at we're just looking at historical volatility. Right now we're not looking at implied volatility, so it's kind of, and we're just looking at for now it's enough for us to say, right, it's like if it's an asset like ETH that relatively is going to be relatively lower, have relatively lower volatility than like a smaller coin. So obviously those parameters are going to be very different. But yeah, and then looking also at setting the parameters for kind of liquidation thresholds and our collateral. In some ways, the leveraged strategies, like in cases when we can borrow against the LP itself, in some ways it makes it, of course, depending on your leverage, it actually makes the strategy a little bit safer because your collateral value kind of moves together with the ETH price. So if ETH is going up, the value of your collateral is also going up. Obviously not as fast. For strategy, but obviously if we're borrowing on Compound or Aave, that's not the case. So we have to be right. So it's kind of different logic around setting those thresholds there.
Can you actually borrow on Aave, for example, giving LP tokens as collateral, or not?
No, you can't. So that there's definitely, and it's like one single big pool. So I feel like that's at least the default kind of design is, there's only a select few whitelisted tokens. So for these leveraged ones, we use this protocol called Taro. It's a fork of Imprimax, which has a pretty cool design for being able to, and they have their own lending pools for each pair, basically. So you can just lend USDC to this like ETH USDC pair, or you can lend ETH to USDC ETH pair, and then on the other side you can borrow those funds and post your LP position as collateral.
Okay, and I have one more question on your Galileo risk engine. I mean, I very much like the name. I'm Italian, so I mean, all this Galileo, Da Vinci stuff, I really love it. But anyways, this 1 to 10 scale that you give to volts, like what is a 1? I guess a 1 would be like I lend USDC on Aave, something like that. But what's the 10? Basically, is it like as risky as buying ETH or smaller tokens? Like, what is your 10 on this scale?
The 10, so it's all kind of relative to this kind of just like the current strategies that we have. But the 10 is probably so right now, yeah, so we do have actually the strategy, right? So this delta neutral strategy, it's on Moonriver. And now when actually the USDC on there is bridged. So it's not native USDC, so obviously carries some bridge risk. So if something happens to the bridge, um, that basically your your losses are 100%. So something like that will kind of push the risk level of a strategy towards 10. So we are looking at these, right? Like, and we are in this DeFi world where unfortunately, kind of these kind of hacks and exploits are going to have an outsized influence on the risk, and they're also obviously the hardest ones to measure and quantify. So we try to have some sort of ballpark estimate of what that risk might look like, and kind of refine it over time.
Okay, cool. So let me get back to Darren 1 second on the on basically what are the users actually doing on Ipor? I mean, it's you said it's not a protocol built for degens. So who is the target user, and what can you do on Ipor? Is it for protocols willing to build something in the rates market? Is it for also retail users or institutional users who want to hedge interest rates risk? So what can you actually do on Ipor, and who is the user?
Yeah, first of all, we're on Ethereum L1, so that limits the the use case just by gas cost, right? But if we're talking about like the function of interest rate derivatives, we're talking about in TradFi you're hedging like 7 figures and above, so it really doesn't. It's really not necessarily a retail instrument unless you're trading different strategies, right? But we consider the Ipor protocol kind of building blocks for the DeFi credit market. They're the ones that sit under the surface. You can think of it kind of as the foundation of a building, right? You don't see it, but it keeps the building from toppling over. And again, going back to the macro, it was the interest rate risk that really doomed these banks. So, for example, what you can play different strategies. So if we look at the size of the credit markets, it's approximately 3 to 4 times larger, the interest rate derivatives. We're talking about around I think 110 trillion, and then 450 trillion notional in the interest rate derivatives market. So obviously it's not all hedging cases, right? So you have speculation, you have arbitrage, you have different plays that you can play with interest rate derivatives that are apart from hedging. But if we look at something, like Sector, you guys could plug this into a delta neutral strategy, essentially use it to hedge your rate risk, on the credit market positions. So, the base case is if you're a borrower, you're going to be along the Ipor, right? So if your cost of borrowing increases, like in the case, where the USDT rates shot up, you're profitable on the derivative, and you will have to pay more on the on the credit markets. But the arbitrage cases, right now, or actually it was quite interesting why people weren't playing when we had really, really cheap DeFi yields, right? So when the Ipor rates were sitting between 1% and 2%, it can be very profitable actually to borrow in DeFi and lend in like in like 2-week, 4-week or 2-month treasuries, right? You can play this kind of arbitrage game there. So there are a number of plays that are very interesting, kind of idiosyncratic to DeFi. The case there is, a little bit difficult because you can't take really leverage on the DeFi loan if you're talking about the over collateralized markets. But it's really useful if you have, like the assets like Ethereum sitting idle. You can take debt against it, to turn it into a productive asset to lend in treasuries. So you can capture that kind of arbitrage opportunity between the rates. There's all kinds of different rate strategies that you can have. And, the one that I was talking about, the divergence play between USDT and USDC, this is essentially, a cross-currency swap because you're going between two different stable coins that have different rate behaviors. And then I think one of the things that will be really interesting, now we see kind of the US choking down on the entries and exit points, even for the stable coins, and MiCA are really taking a hold here, in Europe. I think we'll start to see, different assets coming on chain. And I think the biggest one will be the euro. And so then you'll see on-chain, on-chain Forex. The cross-currency swaps will be much more interesting, let's say, between like a euro tether and USD tether. So, there's a lot of different ways to play this.
Yeah, I certainly hope so. I mean, as a European, I've been long waiting for a kind of a European stable coin and like a larger, I would say, markets in Europe for DeFi, because at the moment I'm very much feeling that US and Asia are a lot more developed in terms of adoption. But in terms of regulation, actually, Europe, as you mentioned, it's actually pulling ahead, provided they can actually deliver and pass the MiCA regulation that might be coming late next year. But yeah, I mean, let's see how this goes, of course. So basically, going back to one thing you said, Darren, so if I'm a protocol and I want to borrow some USDC, for example, because I need that to make my protocol function, then I can hedge my interest rate risk by buying this Ipor product that basically locks in a rate for 1 month. That is correct.
Yeah, that's correct. And actually, we think so. It depends on what side that you're on, but we're looking at different like simple products, and maybe this can be an interesting integration for sector, which is mostly like you have these DAO treasuries, which are essentially like the fixed income players of DeFi right now, and so they're typically going to be the short the interest rates, and so the Ipor really focuses on what is the risk-free proxy in DeFi, which is the over-collateralized lending markets, right? So you can consider it like a benchmark that you can, if you're yielding above the Ipor, that's your risk-adjusted yield, right? So you can think of it as a nice kind of, benchmark for risk. And then you can use it, if you're thinking about getting like, low risk yields, you're going to deploy into Aave, you're going to deploy into Compound, or you're going to deploy into, like an Ipor like Vault, and then take the short side. So these are some potential integrations, with a lot of the DeFi players. And we'll be launching some of these protocol integrations.
Yeah, it's
Really cool.
yeah, definitely
Really
interesting.
cool.
I think these conversations are always cool, just learning about potential ways and protocols can collaborate.
So, guys, I say the discussion were super advanced and super interesting. By the way, so I really enjoyed it. It was too advanced for me, that's why I couldn't even add my TradFi background. Didn't help me that much this time, fortunately. But I'm sure many people will find, like the details that we need to share more. Here we're chatting about volatility and risk. One thing I can add on my side is that too many times in DeFi, risks of the protocols are explained so badly that in the end people simply say, okay, there are some risks, and no one is really looking at them in details. So you have people, as a sector, for instance, said at the beginning, in UniV3, people deposit for a UJPY, super concentrated liquidity, not knowing they are basically bearing a stellar impermanent loss, potentially losing everything. This is an example, but you have also a lot of like tail risk into other protocols simply there. No one really say, okay, you have that risk. So it's probably we shall all spend more time into the complex stuff, but that you need to know once when you are investing in advanced protocols, as many DGens are doing. But to close this interesting Twitter space, I want to ask you all, what are the next steps? The kind of standard question, what are the next steps for your protocol? So people here and people that will listen to it later could say, okay, actually, I'll check it out, I'll turn on, I'll be ready to see the new things coming. So I don't know, maybe Sector, you want to start, then Ipor, then Nicolò.
Sure. Thanks first to the Smilee team for hosting this and everyone who listened in. Yeah, for us, we launched earlier this month. We've got good traction so far, but you can come onto our platform. We're sector.finance, test out our products. Again, we're a structured products protocol providing one comprehensive risk analysis. And then what we talked about today are these more delta neutral market making investment strategies. You can kind of invest based on your own risk preference. The other big announcement for us is that we are doing our public launch on Camelot Dex March 29th. So that's the big next event for us. We'll pass it on to the Ipor team.
Okay, cool. Yeah, thanks again for also having us. So next on the roadmap, so we have a lot of interesting things bubbling under the hood at Ipor. I mean, the biggest one is starting to extend the maturities of the swaps. And that really starts with one kind of a rework of the risk engine. So we had to reterm a lot of things in the protocol. So for example, if you're on the the money markets, you're looking at utilization, in terms of percentage in the pool. If you look at Ipor, you're thinking of utilization more as portfolio risk, right? So the liquidity providers are they have a portfolio of long and short positions that they're essentially underwriting. So reterming of that, building a really comprehensive risk engine, and also getting the triggers to cap the utilization, to cap the leverage dynamically. And then once we launch that, it's actually going to we're going to remove one of the parameters, which is the optionality in the contracts. So what that will do is it will actually compress the spreads and then let this kind of risk engine go to work. So once we do that, then we'll be able to easily start extending the duration of these swaps. It'll make it much more useful, for longer duration instruments. The other part is actually we have a number of basically products or protocol integrations that are bubbling under the hood. I'll be with the dev team on early next week to discuss those. So depending on the prioritization of what goes out, then we can announce those. But we have a couple of different protocol to protocol integrations bubbling under the hood. And then finally, I'll be in Frankfurt next Thursday at the Crypto Asset Conference at Frankfurt School of Finance and Management to discuss, building a $450 trillion opportunity inside of DeFi. So that'll be nice because it's contextualizing, this what's a very kind of best of both worlds TradFi and DeFi instrument in front of for some of the top bankers in Germany. So it's always a cool kind of back and forth, and to show how this DeFi world is maturing. So I'm really looking forward to that.
So I'll go with Smilee Finance. Of course, we just launched testnet last week. So for us, the journey is at the beginning. We did our first week. Everything went smoothly, and today we actually managed to list Arbitrum within 1 hour of them basically launching the token. So, I mean, from what they tell me, it went smoothly. I didn't really have time to trade it within Smilee, but I mean, it's pretty cool how we can actually list tokens very quickly on Smilee. As long as we have basically liquidity on one side, we can mint derivatives on the other side immediately. And of course, there are plenty of things to do. So we are running a trading competition for 4 more weeks, basically, where people are battling each other, and different teams are battling each other to make most money as possible on Smilee, trading different tokens. We listed a lot of tokens from our partners, from Camelot to Camelot Grail to Trader Joe or Y2K. So yeah, you can trade a lot of these Degens tokens on testnet at Smilee. During this trading competition, we are gathering a lot of very useful feedback on how to improve our product and how to basically add features before mainnet. Mainnet is going to be probably about 8 weeks away, I would say. So like still a lot of work to do there. We need to do the audit and everything, and we hope to be ready for shipping the product within 8 weeks. Yeah, so starting from there, we will need to add more features. For example, the possibility to exit positions early. So once you buy a derivative, you don't really want to hold the derivative until expiry. Maybe you want to get out early. So we're working on this, as well as we're launching some derivatives with a very high delta. So for now, we only have impermanent gain. That is a way to short impermanent loss with a huge leverage. So you can go on Smilee, put $20 and you can short $10,000 worth of impermanent loss on any pool you like. So this means 500x leverage. We want to launch even more leveraged products, shorting impermanent loss on just one single side. So you can, for example, bet on the upside or bet on the downside while shorting impermanent loss. So yeah, a lot of different products to add. A lot of more products on the roadmap with insurance, variance swaps, credit default swaps. All of these can be built by just combining these derivatives that we can build on Smilee. So a lot of things to do, and very excited about the future.
Well, guys, amazing. I say all of us, all of our protocols have been working on amazing stuff, and there's very much coming down the road for this year. So, I mean, what can I say? Hope to have another one soon of this Twitter space. Again, getting back into the complex and advanced topics and explaining better how to use all the things we will be shipping soon. So, thank you for your time. In the meantime, thank you, everyone. I say we can quickly go for the questions, if there are some, before we can then go to start building again. So let's see if someone has some question. I don't see in the chat for now. Let's give a couple of minutes and then. In the meantime, I confirm to Tempesto our votes on Arbitrum are fine. I was checking them during the Twitter space.
That's good to hear. I mean,
I say we are good for today. As said, thank you everyone. It was a pleasure really having you here, and let's speak to you soon then. Bye bye.
Thanks, guys.
ciao.
Ciao, ciao.
Thanks, everyone.
Thanks, everyone. Ciao.